Hello there traders, my name is Raul Rivera and this is the Cumulative Tick Volume Indicator 101. This is an introductory course on time and sales manipulation, bid and ask imbalances, and institutional order flow. Before I go any further, first a required disclaimer. So what is time and sales? Time and sales is a log of executed orders. This log is broken into three sections. The first is time, the time that the order was executed. Number two is price, the price that the order was executed. And number three, quantity, which is the amount of contracts that were executed at that price at that time. Time and sales is important because it is a public book of all executed orders in the market. We can literally see these orders by time, price, and quantity. But looking at time and sales during the day can be very difficult. In a market like the E-mini S&P 500 futures, there can be anywhere from 500,000 to 3 million plus contracts in total volume per day. It is not easy to keep track of all of these orders at the speed of the market. Thus, many traders just ignore this feature of the NinjaTrader platform, but what is left behind is a gold mine. There is arguably no such thing as dark pools in the futures market. Dark pools are trades between individuals outside of an exchange, also known as dark liquidity. One of the primary reasons why dark pools exist is because liquidity can be difficult to locate for large orders in equity markets. Futures markets do not typically have this issue because of a few mechanisms like implied pricing and are not limited to a fixed number of contracts, whereas in equity markets, a secondary offering or a split needs to happen to create more shares. Some futures markets like the euro have a matching mechanism of pro rata priority instead of FIFO, which stands for first in, first out matching. So there is arguably an incentive to display your large order on the public book if you want to get filled at a particular price. Knowing this information, it is imperative for traders to know more of the time and sales. With our software, we manipulate this data and have algorithms to determine the overall volume sentiment, and we also manipulate this data to locate institutional volume. Our algorithm can also distinguish the difference between buying orders and selling orders. This is a unique feature because in the futures markets, there is no such thing as a mid-market order. In the stock market, there is a regulation called the NBBO, National Best Bid Offer. Some markets are also not as liquid as others, thus some orders must meet in the middle. If Apple's stock is offering $150 a share and the bid is $149.90 per share, then a trader can possibly be filled at $149.95 per share, which is the mid-market, meeting in the middle per se. Futures markets, bid and ask spread is usually one tick wide, thus the possibility of a mid-market fill is not possible. Also, think of it like this. If a trader is looking to execute an order on the ask, they are looking to buy the market. If a trader is trying to execute an order on the bid, they are looking to sell the market. But in the stock market, there's this thing called the mid-market, but it could be both buying or selling. We can't really tell. It's a really clever way of sneaking in orders. Now, knowing if a trader is buying and selling is important because if everyone is buying, you should be buying, especially if the institutions are buying as well. Institutional order flow is very important. In the equity markets, they call institutional orders block trades. In the options markets, they call larger than normal trades unusual options activity. In the futures market, well, there really isn't a name for it, but the Cumulative Tick Volume Indicator will display this information to you and can be manipulated to your liking. For example, in the E-mini S&P 500 futures, we know a few things. The initial margin is about $4,600 per contract. The leverage on this index is 50 times the index. So if the ES is trading at 24.90, then 24.90 times 50 equals $124,500, which is the capital you control with only $4,600 down. The risk versus reward is $50 per point. So, looking at this information, if I get long 25 contracts, then I would potentially need $115,000 in initial margin. I would be controlling $3,112,500 and could be making or losing $1,250 per point. So the question is, does the average individual trader have the ability to potentially lose over $1,000 per point in the S&P 500 futures? On average, the high and low range of the ES is about 12 to 20 points, meaning that you could lose over $12,000 to $20,000 per day if you're trading 25 contracts. I'm going to assume that at least 85% of all individual traders are not looking to risk that much per day, but institutions have access to millions and billions of dollars, meaning that 25 contracts in the ES is on the minimum amount of contracts that they actually trade. With the Cumulative Tick Volume Indicator, you can adjust these settings so that you can see the trades placed in the 25, 50, 100, 500 or greater contract size trades. Or you could even just create a range of contract volume and imbalance that you want to see. Okay, what we have here is a 15-minute chart of the E-mini S&P 500 futures. On the first pane, we have the Cumulative Tick Volume Indicator, and on the lower pane, we have a Standard Volume Indicator. The settings on the Cumulative Tick Volume are currently set to look for 50 to 200 contract trades. So what does that mean exactly? Very simple, very easy. We are looking for 50 to 200 contract trades. If there is an order that gets executed of 201 contracts or greater, it will not be included on this chart. If we get a contract order of 1 to 49 contracts, it will not be included on this chart. So what we are doing is we are extracting 50 to 200 contract trades and displaying those trades on this bottom pane in a candlestick view. It could also be displayed on a histogram view, which I will show an example of in a little bit. Now, since we are looking at institutional order flow, how do we know that they're buying more than selling? Well, that's very easily explained through candlestick charts, right? We all know our normal candlestick charts, but here what we're looking at on the top pane is a price chart, right? Where prices are going. Here on the bottom, what we're actually seeing is an accumulation of orders either to buy or sell. Remember, trades on the ask equals a buy, and trades on the bid equals sell. So taking the difference between orders of bid and the ask between the 50 to 200 contract trades, we get a positive number or a negative number. Here on the right axis of this pane, we can see that. Here's 0, and here are all positive values. Here are all negative values. So when we take a look at today's trading, we can see that the institutional traders were pretty much buying all session long as the market continued to grind higher and higher. One way to interpret this data is by comparing it to the candlesticks. We know that, if we zoom in a little bit further, we know that on this bar, there was a lot of institutional volume, and we can see the result of a 15-minute period. Lots and lots of buying. Big bar. Here we can see there was some buying, but the bar ended in a doji. Here on this bar, we can see that it closed higher than it opened, but the 50 to 200 contract trader actually started to sell. And that could be a warning sign, right? That prices could possibly pull back. Here we can see that they pulled back quite a bit. And then we also see that this pullback is actually being done on very low volume, right? Volume throughout the day is decreasing. Suddenly, we start increasing in volume, and lo and behold, the 50 to 200 contract trader is right there buying the market up. Now here they start selling it a little bit. You get a small consolidation phase between those two bars, and then once again it's being done on very low volume. Suddenly we get high volume again, and it's the 50 to 200 contract trader, and that's when the market started moving higher. And as the 50 to 200 contract trader was buying, we can see that the overall market is moving lower in volume. Thus, we can arguably say that that's the cause for the consolidation, right? The 50 to 200 contract trader is buying, though volume is very small. That's one way to analyze this data and interpret what these big players are doing. Now, so far, everything I've been showing you is based on a 50 to 200 contract size trader on the S&P 500 futures on a tick mode called chart cumulative. What that means is that the chart itself begins from 0 on the very first trading session that is on your chart, and accumulates consistently throughout every single day and does not stop. It continues to accumulate for the entire chart and the entire set of days that you're looking at. At the moment, I'm looking at 5 days. That could be easily changed. Here we can see cumulative tick mode. We have 3 different options to choose from: daily cumulative and non-cumulative. First, let me explain daily cumulative. And daily cumulative resets to 0 every 24 hours. So this first trading session begins at 0, closes at either a positive or negative number, in this case a positive number. On the following day, resets back down to 0. This day finishes on a negative number, resets to 0, finishes on negative number, resets to 0, finishes on a very high positive number, resets to 0, and you can see the continuation of the trade there. And this is called daily cumulative, which means it only accumulates the data from the 50 to 200 contract trader each individual day, resets to 0 every single day. And then you have non-cumulative, which literally only takes into account 50 to 200 contract traders on a bar by bar basis. on only a bar by bar basis. Let's zoom in and see what this looks like. So here we can see that on this bar, we had more buyers than sellers in the 50 to 200 contract trader. On this bar, more buyers than sellers. On this bar, more buyers than sellers. This big bar here, a heck of a lot more buyers than sellers. This bar, more buyers than sellers. And what's interesting about this chart is that it's being viewed as a candlestick, but it resets to 0 on a bar by bar basis. And much like a candlestick, it has wicks. So on this bar here, we can see that there was a little bit of a struggle between buyers and sellers. And it shows up perfectly, on a 15-minute period here as a doji. Ultimately, there were more buyers than sellers. Looking at this chart here, there were more buyers than sellers, and we continued higher. And then suddenly, throughout the next 4 bars, we had more sellers than buyers. Then on this bar here, let's see, this one, actually it's the doji. That's pretty funny. A lot more buyers than sellers on that doji, some sellers on this bar, and then a lot of buying on this bar once again. So as you can see, it's on a bar by bar basis. Each bar tells you how much positive or negative imbalance it had between 50 to 200 contract traders. But this we can also manipulate, 50 to 200. It could be done fairly simply. Just go to your indicators, go to the cumulative tick volume, and adjust. Let's say I want to take a look at every single trade. I'm just going to do one, and I'll just do this as 20,000. I don't think there's a trader out there making 20,000 contract trades every single day. And I'm going to keep it on non-cumulative on a candlestick plot mode. And as you can see, it also plots as a histogram, but I'm going to keep it as a candlestick. I'm going to go ahead and click OK. The chart is going to load. And here we can see 1 to 20,000 contract trades. And what we notice is on the 1 to 20,000 is that on that doji here, there were actually a lot more sellers than buyers. So everybody was selling on that bar, but the interesting part is that the 50 to 200 contract trader was actually buying. So as you can see, the indicator reveals a lot of very useful information. It tells you who's buying, who's selling, and it does it for you in a very unique display form. Let's say I want to take a look at every single trade that occurred, right? 1 to 20,000 contracts. And I want to take a look at it on a daily cumulative mode. And this time we're going to take a look at it on a histogram view. So I'm going to switch this to a histogram. And I'm going to switch this to a daily cumulative view. I'm going to go ahead and click OK. Let the indicators load. And here we can see it now as a histogram view. Nothing but buyers all session long, higher, higher, and higher. If I go on and show it to you this way, you can see that it resets to 0 and how it plots. And usually most of the volume always occurs during the US session open. On this day we had very little volume, and this day we had somewhat okay volume, very little. And again, just consolidation periods, low volume consolidation periods. Here we have quite a bit of volume. You could even see it on the volume indicator here. And one thing to note as well is that, your volume indicators down here, your standard volume indicators, they'll only count all of the volume that traded in the entirety of each bar. But they will not tell you whether it was more buyers than sellers or more sellers than buyers. Here we can see that on this bar, we had about 12,557 more contracts to the long side than to the sell side. And in this bar, there were 116,000 contracts that traded. So out of 116,000 contracts that traded, there was an overflow of 12,300 contracts. And that's amazing. That's great information to have. But again, this is looking at everybody. This is looking at 1 to 20,000 contract trades. Let me go back and look for institutional order flow again. And I'm going to pick anywhere, for fun, let's do 500 contracts and greater. We'll leave it at 20,000. 500 contracts and greater on a histogram view on a daily cumulative form. Let's see what this looks like. And here we can see that throughout the entire session, there were no trades of 500 contracts or greater, except for at the very end of the day. Now we know that towards the end of the day, usually that's when mutual funds begin their buying or selling, so on and so forth. Here we can see there was just the one 500 contract trade, or 500 to 20,000 contract trade. But because we're looking at it as a histogram, it seems as though it's everywhere, right? Throughout all these bars. But in reality, if we take a look at the candlestick form, we will notice that it was just one singular trade on this doji bar, interestingly enough, and for the rest of the day, it was just quietness. So one trade of 500 and greater. And if we keep going and going, I'm sure we'll find, I guess not another trade within this 5-day period. So we had 1 and 2 trades of greater than 500 contracts in a 5-day period. But as I mentioned before, 50 to 200 contract trades is the sweet spot for the E-mini S&P 500 futures. 500 or greater, it shows that someone is positioning themselves. A 500 contract trade is not day trading. They're not looking for short-term gain. They are possibly positioning themselves for a bit longer term. And you can manipulate this data as you wish. I like the sweet spot of 50 to 200. Going back to daily cumulative. And here we can see better intraday information of what's going on with these institutional buyers and these institutional sellers. Also, a really unique way of using the indicator is by using multiple instances of the indicator. We don't just have to use the indicator once on our charts. So, just to show you a little trick here, I'm going to go ahead and add a second instance of the indicator, and this time I'm going to look for 1 to 10 contract trades. Now, why 1 to 10 contract trades? Well, 1 to 10 contract trades are the highest frequency of contract sizes in the S&P 500. 1 to 10 contract trades occur more often than 50 to 200 contract trades. So there's a lot more volatility involved when we're looking at 1 to 10 contract trades. Also, if you have ever heard of buy programs and sell programs, these algorithms, when they are triggered, they always execute in 1 to 10 contracts, maybe a little bigger, maybe 1 to 20 contracts, but 1 to 10 contracts is usually the sweet spot for these buy and sell programs, and we can literally see them come to life. Thus, we really associate 1 to 10 contracts as volatility. So I'm going to show this on a daily cumulative histogram, and then I'm going to come back over to 50 to 200 contracts, and I could either leave it as daily cumulative or change it to non-cumulative. And I'm just gonna click it on non-cumulative, and let's load up this chart and see what it looks like. Now the volume pane is sort of in between. I'm just gonna move that one lower, move down, thank you very much. And here now we can see 50 to 200 contracts non-cumulative, and 1 to 10 contracts cumulative, right? So as we can see, the regular buyer of 1 to 10 contracts was long this market all day long. So I would probably be looking to get long with them, right? The volatility is there. 50 to 200 contract traders, as we saw, was also to more to the long side. But what we want to wait for are periods where we either have, just unconfirming signals. So here we can see there was a red bar here and a green bar there. And then we switched over from green to green. This could be taken as a buy signal right there. Get long, because both institutional traders and volatility traders are in the market with you. Here we can see a difference. Here we see a difference. Now, I wouldn't necessarily go short simply because these two are confirming each other. You could do so. The short would be right there. But with the overall market being long or above zero, right, in positive territory, I probably wouldn't be looking to short. But aggressively, you could be looking for a scalp right there. And as things turn from red to green, these two confirm each other. It's actually the doji. These darn little dojis. This could be taken as a long signal, because we know volatility is green and the institutional traders are also buying. Good place to start buying the market, because if everybody is long, we should be long, and if the institutions are long, we should definitely be long, right? And so on and so forth here. Again, just actually a little bit of delta divergence. We have a bar that closes above its open on negative volume. Here, these signals don't match. And then here, these signals match. This one goes all the way up to this one here. So getting long right there. And you can see, the trade worked from there as well. So we could use volume, actual executed volume order flow, as a trigger to get long or short the S&P 500, crude oil, gold. This indicator works on every single futures contract. Now, some of the settings will have to be changed. We know that the S&P 500 can trade anywhere from 500,000 to 3 million contracts, but that's not to say that the crude oil market trades that much. Crude oil really trades anywhere in 500,000 to 900,000 contracts. Sometimes it crosses over into the million mark. Gold usually trades about 300,000 contracts. So we can assume that, 50 contracts and greater type of trades are not going to be visible in gold or crude oil. We're actually going to see about, large institutional traders would be about 20 contracts or greater. In the S&P, of course, 50 contracts or greater is really the sweet spot. And here we can see how we could use it as buy and sell signals. And it doesn't necessarily have to be only on a 15-minute chart. We can do this even on a 5-minute chart. Now the frequency is a little bit faster, and it does increase the probability of choppiness in the market. But if you're trading in the most active hours, it can get you into a trade a little bit faster. So let's start from here at 9:30. We can see no institutional traders, a little bit of negative volume right here, and then we have institutional trader with volatility. Get long on this bar. Works out nicely. Here we have a little bit of a difference. Here we have a little bit of a difference. Difference, and then here once again, this is what I mean by chop. Here the signals confirm. If I keep moving higher, we have a red bar. Maybe we don't get a long, or maybe we take the long and take that risk, but on a red bar we probably would want to skip that one. Keeps going. Here's on confirming here, confirms short, but the overall market is long. We're above zero, so I probably would be skipping a short here. But if you're a risk taker, a little aggressive trader, getting short right there pays off for maybe a few ticks if you held it through that. And then here it becomes green again. Get long on this bar. Have to hold on to it for a little bit. If you don't get long on that one, you could get long on this one. If you don't get long on any of those, you could get long this one. Green on green. Green bar, get long. Couple opportunities here, here, and here to get long the market. It even works on range bars. If you're a range trader, we can take a look at a 5 range in the S&P 500. So here's a 5 range chart of the S&P. The information is all one and the same. Nothing's changed here since the open. Here we have a difference. Here we have correlation, getting long right here. Works out to be pretty nice on this day, of course, right here. Get long right there. Works out very nicely as well. So as you can see, it works on all bar types, and even our TechMe's Trader and themarketprofile.com custom bar types, such as the pullback range and pullback Renko. If we take a look at the pullback range, here we could also see it working as well. Now this is a bit of a slower range type of bar, but here we can see that there is red on a green bar. Probably not a good idea to get long. Here we have green on green on a green bar. Sets you up right there for the long, and up she goes. So if you like what you're seeing, give it a test drive. Claim your free 14-day trial of the Cumulative Tick Volume Indicator today. Supplement your trial with my live futures trading room. All you got to do is sign up for free, www.themarketprofile.com. I trade using the Cumulative Tick Volume every single day, so definitely come and check it out. I also trade index futures, commodities, interest rates, and much more. If you'd like to know more information, send me a friend request on TechMeetsTrader and let's chat today. Or send me an email, Raul@techmeetstrader.com. Thank you guys and happy trading.